for allowing us to stop in. Just for introduction purposes, my name is Brett Holland. I'm with Stifel. This is Brian Payne. He's a director at Dearborn Partners, one of our managers that we utilize. And this is Michael Aldeman and Aldeman. I messed it up, sorry, Aldeman. He's a portfolio manager there. Mike Battistelli and Mike Battistelli, and Sonia Gross with Stifel as well. So thanks for having us in. So we want to give Dearborn time, like we always say, to give them proper time to be able to kind of explain a little bit of what's been taking place. We want to start out just by saying congratulations to recent election for each one of you. So congratulations to each one of you for that. I want to talk about, I guess, two quick things. I just want to mention the investment policy statement. Each year we try to have that reviewed just for you guys to look at. And if you like, afterwards we can leave some copies with Jamie. And then typically our February meeting, I think we ask you to maybe sign that just to say that everything looks fine with that. Unless there's some changes that you as a board feel like need to be done with that. So if it's okay, we'll just leave those with Jamie at the end. Getting into the report here, the report that you have in front of you, we're just going to open up the first page like we normally do. And just to look briefly at the performance, and then Mike will have the up-to-date, year-to-date numbers for where we're at. And this is through the end of September 30th is what it is, so through the end of the quarter. On the top left-hand side there, you'll see the bar chart. And this is the combined portfolio, so everything kind of all together for the quarter was up 1.9% for the quarter, for the third quarter. Year-to-date numbers, so for the first 3 quarters of the year was up 16.5%, and the one-year number was 6.8%. And you can kind of see the 3-year and the inception numbers as well after that. Mike's going to go over a little bit about the withdrawals, so I'm just going to go straight to the bottom of the page there. Again, talking about the investment policy statement, this is something that we try to keep a close eye on. We did tweak this back, just kind of rebalance a little bit several months ago when we were in. The equity portfolio right there, the equity piece is showing at 63% right now. It's actually 57.6%, and part of that equity piece we always say is the REIT portfolio, the Real Estate Investment Trust, which represents 5.5%. All those are within the parameters of what the investment policy statement deems. And fixed income at 29%, cash is at 7%, and so from that standpoint, the allocation is appropriate per you all's direction. I just want to mention one thing. One manager, I'll just have you flip the page if you want to go to page 2, has the breakdown of the different managers and so on that we utilize. The very first one that's listed there is AMG, or sometimes you see them as Aston or Fairpoint. They're a manager that's been in the portfolio for a very, very long time, for well over 10 years. They're what we call a mid-cap manager. And we are probably, we don't want to do it today, but Mike and I will probably come in or be speaking to you maybe between now and then, making a recommendation to remove them and to replace them with someone else. I won't get into all that today unless you have questions on any of that.
I can wait.
You can wait, okay. Thank you, Commissioner. And that's all I have right now. And then Mike's going to give updated numbers through the last day or so here.
So the numbers that Brett gave you are audited numbers. The numbers I'm giving you are unaudited, but they're as accurate as we can get them today. So through Tuesday, the pension plan was up actually 19.23%. Allocation.
Over what period?
January through Tuesday, through this past Tuesday. The allocation is virtually the same. And again, I just want to remark on that. The last time we were in, we did pare back the equity exposure a little bit. If you remember, we were 62, 63% in equities, and we pared that back. And we're still at the upper end of the range, but we are under the range. And I think that was a responsible thing to do at that time. And I don't think it's hurt your performance at all, frankly, in doing that. As far as withdrawals, the net withdrawals during the year is $4,282,801. And I say net because obviously you make your annual contribution. And again, as of Tuesday, the pension balance was $131,201,948. So that's kind of where we stand. It's kind of a higher, I think that might be one of the higher watermarks that we've had actually during our reporting periods anyway.
We were talking about that yesterday. We thought would be 130.
What was the number again?
131.
Okay.
131, 201, 948. And then regarding the pension, we are recommending, or we would like to raise another $2 million in cash for future distributions. Cash position's not large enough. What we're trying to do, we've had a great year. I think we would all agree with that. And just trying to pull some cash, take some of the profits, if you will, or the growth off the table, because we know we have future distributions. Rather than, if we happen to get into a bad market, having to sell some investments when we don't really, maybe at a time we don't really want to do that. So we would do that, and I think we would be, we were trying to project out a little bit, but I think we would be pretty close to having enough cash in the plan then, up until you make your next ARC payment. And then that's what we've been doing with the ARC payment, is keeping that liquid for distributions.
Traditionally, what kind of interest does that cash draw?
It's getting around 2%. It's basically in a money market. So seems pretty reasonable. It's safe. It's liquid. We liquidate it when we need it.
When you say it's safe, it's not like FDIC insured.
It's not FDIC
but it's safe from
insured.
the volatility of the
Right,
market.
right, yeah.
It's actually invested 100% in U.S. Treasury bonds.
Oh, okay.
Jimmy, when do we usually make that ARC payment?
About May or June, I think, is that right, Sally?
I think so. I believe that's when we made it last year.
May or June?
Payment, what it's now, our
I
payment.
think it was around that time this year.
Around May.
Once we have it all set aside.
Yeah, once we get the report, the report comes usually in late April or
Right.
late May.
Mhm.
And after that's when
Thank you.
Well, I'll make a motion then to,
I think he had it.
No, go ahead.
I'll make a motion to allow the $2 million to be moved to the cash segment of our portfolio.
I don't think we need a motion.
No, they have the ability to move the money as
So
manager.
it's not outside of our
No, it's
percentage?
still within
No.
your,
Okay.
yeah, within your pension. We just want to let you know that's what we were
Okay.
planning on doing from the strategy
I
standpoint.
thought you needed an approval on that.
One other issue here, talked briefly to Jamie about this the other day, because I wasn't sure how we wanted to present it. We've got notice this week that CS McKee, which is one of the money managers that we have, they have all the fixed income investments as well as an equity sleeve in the pension, is actually going, they're actually going to sell the company to a private equity firm. And we're not really concerned about this change. We think it's not really a material change. Everything is staying the same. The reason that they're doing it is their two principal owners are getting older, and this is their succession plan. They're trying to get them kind of righted and out of the company. Those two individuals really have not been that involved the last couple years. The investment team, the management team is all staying intact. They've all signed 5-year contracts. They're keeping all the employees. So it does not, to our eyes, does not look like it's really going to change anything. It's still going to be considered CS McKee. It's just a way of facilitating this succession plan.
Is there a big chunk?
They are a big chunk. You're talking about $55 million of the pension. We've had CS McKee, you guys have had CS McKee forever.
Yeah.
They do a great job fixed income wise, and the equity piece has been very
It's
good.
stable.
It's very stable. They've been an asset to the pension plan, to be honest with you. So I think, again, we're not, making a recommendation. They are asking, CS McKee is asking for signatures that you're okay with that, and that everything will continue. Services will stay the same, cost and fees will stay the same. And this should happen, they're predicting by the first of the year, is when they're looking at that to happen.
Mr. Controller, any comment on that?
No, I see no problem with it, and I feel comfortable if I guess I was okay with it, and everybody's gonna do the same, I don't see it being a real change. I would be more concerned if there would be a change in people that are there.
Right.
that's fine. I can see it, you know. The same people are gonna be there, so I don't see an issue with that.
What I'll do is a letter from CS McKee explaining everything, so I'll give that to Jamie, and then behind it are the signature pages if you're so inclined to.
And does
sign
this
them.
take a vote?
I don't think it hurts to take a vote on this one, you know, to authorize the letter acknowledging the change.
I'll make a motion to sign the letter recommending a change to CS McKee's new
Structure.
structure. There you go. Looking for a word.
Second.
This is the first time hearing about this. I haven't seen the letter, but based on your recommendation, I'll go ahead with it. Any discussion?
Bob, second. You have this, I just wanted to know you have a second.
Okay, anything else? If not all in favor of the motion, please indicate by saying aye.
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 Opposed, same sign, so moved.
And that's all I have for you. We're going to turn it over to the gentleman here from Dearborn. They're going to talk a little bit about their strategy and portfolio, and maybe give a little bit of insight to the markets.
Great.
Yeah, sure. Good morning. It's great to be here. You have a second packet here. This is the Dearborn Partners Rising Dividend Strategy. Give you a refresher on the strategy, maybe talk about what we're seeing in the markets and what's going on in the portfolio. So yeah, quick refresher on Dearborn. We're privately held, independent, registered investment advisor based in Chicago. Founded in 1997. We're SEC registered. 25 total employees now, just hired a new employee recently. About $5.8 billion under advisement, under management. Next page is our investment team. So there's 5 of us on the investment team that make all of the investment decisions for our rising dividend portfolios, which you're invested in. You're invested in our core rising dividend portfolio, which I'll get into the details on that in a minute. But, Carol Lippman here, who's my co-portfolio manager, joined us in 2011. We've been running these portfolios since, so just a little over 8 years. Pete Dekas joined us 2.5 years ago. Came from Wells Fargo as well, portfolio manager, added to our rising dividend team 2.5 years ago. And then Matt and Jack, analysts that have been with us since Carol joined us in 2011. So we split up our investment expertise in stock picking by sector. I cover healthcare and technology for us. Pete Dekas covers energy. Matt covers the consumer side, so consumer staples and consumer discretionary, and then Jack, utilities and industrials. And Carol's more of a generalist. So what we look for in companies, this is a rising dividend portfolio, so every company in the portfolio that we're going to buy for you in the portfolio pays a dividend, and it's a company that we feel comfortable can increase its dividend year after year. And I'll go through the results here in a bit, but we're looking for companies that have market leadership with high barriers to entry, solid financial condition with very strong balance sheets, so plenty of cash on the balance sheets, growing cash flow. Dividends well covered by cash flow and earnings. So we're looking for companies that are making a lot of money and they're increasing their cash flow and earnings every year, and most of the time even through a recession. So we've gone through a 10-year bull market here. Economy's still growing. Question is, we're at new highs here in the market. What happens in the next recession? Well, I'll show you here in a few slides. Many of these companies have been through this before and have been able to increase their dividends through tough times in the economy and in the markets as well. Turn the page. Over time, earnings drive stock prices. So this is what we focus on. You have 2 lines here. The solid, smaller blue line that's a bit more steady there is the earnings of the S&P 500 companies in aggregate. And then the thicker, kind of lighter blue line that's a little more volatile there is the stock market. So you can see these don't run exactly in tandem, but over time, stock prices track the earnings of the S&P 500, of the companies, the underlying companies. So you can see back in 2010 and 11, stock prices were a bit below that line. Market was undervalued. Now you can see a bit more volatile here in the last couple of years, and we're now above the earnings line. But where we sit here today, with interest rates as low as they are, we don't feel like the market is overvalued per se. We think it's fairly valued, and that's why we think earnings here going forward, if this earnings line can continue to increase, and that's the names that we're focusing on, companies that can grow their earnings even more than the overall market, we believe that the price of these stocks will continue in tandem with that. So our core rising dividend separately managed account, SMA stands for separately managed account, which you all are in the pension fund. We're looking for companies, mid and large size companies, so $1 billion market cap on up, at least a 1% dividend yield or higher, so at least a 1% dividend payment based on the stock price, and then low leverage, low levels of debt. And then we get this list of companies. We have a universe of companies right now that's actually 187 names. These are companies that we follow closely. These are companies we feel comfortable can increase their dividends year after year. And